Welcome to Daybreak Asia. We're counting down to Asia's major market opens.
Australia has just come online. The top stories this hour. Weight in stocks may rise as investors brace for a busy week. The Fed and other central banks due to release their final policy decisions of this year. China's top leaders pledging to strengthen fiscal support, raising expectations for next year's growth target, even as the economy faces more deflationary pressure. And Japanese Prime Minister Fumio Kishida reportedly set to replace 15 officials amid a scandal over slush funds. We're taking a look at, as we set up for really that busy week that I was alluding to. Of course, these policy decisions, even if we do get holds and sort of just more communication as to the path ahead going into 2024, they do affect about 60% of the global economy. And of course, the Fed is the one that is front and center, given how much market pricing there already is for rate cuts. It'll be very interesting to see the level of signaling that we get from Chair Powell this week, given the precarity of that situation. We're actually seeing Asian stock futures kind of handing back a lot of those earlier gains. The start of the cash trading session here in Sydney looking pretty flat at the moment. After a largely positive futures session, we are also seeing a little bit of distraction when it comes to bonds as well, when you take a look at how bond traders will have to navigate what is going to be a monumental week this week in terms of those policy decisions that we were talking about. The Aussie dollar is holding at 65.77, really looking at potentially one of the more volatile currencies that could be traded, given we are expecting broadly more downside trajectory for the greenback. Elsewhere, we're seeing pretty flat trading in New Zealand. We're certainly off those session lows of this morning. Chicago Nikkei futures also handing back some of that early positivity to trade pretty much flat at the moment. We're watching really some of the political fallout when it comes to Japan at the moment, with big changes when it comes to these ministers as well as other government officials that could be set to lose their job over the funds scandal. Also watching, of course, China as we get the messaging from the Politburo meeting at the end of last week was really interesting in terms of potentially a bigger push for fiscal support, and much less when it comes to what we expect from the PBOC, Shery, which in a lot of ways makes sense given the limited ammunition that we have when it comes to monetary policy now.
Yeah, we're not really expecting them to do much. Perhaps sort of a same story when it comes to other central bank decisions this week, including from the FOMC that's expected to hold rates steady for a third consecutive time. But take a look at how U.S. futures are coming online in the Asian session. Pretty muted after we saw stocks rising. On Friday, we had really expectations that the U.S. will be able to avoid a recession. So the S&P 500 gained ground for 6 consecutive weeks now. This, of course, on the back of that Friday's jobs report that showed unexpected strengthening. We also had the U.S. consumer sentiment data rebounding sharply in early December. So traders are not really expecting much this week, but they're also trimming their bets on rate cuts in 2024. So we saw Treasury slumping with the 2-year yield jumping above 4.7%. When it comes to oil prices, take a look at Brent under pressure right now after gaining ground on Friday on that stronger U.S. data, but also U.S. plans to refill the strategic petroleum reserve. But suffice it to say that in the long term, we're talking about the longest weekly losing streak for oil since late 2018. And of course, Heidi, a lot to do with those demand concerns, especially perhaps the weakness that we continue to see in China.
Yeah, and the steeper than expected fall when it comes to consumer and producer prices for November, really heightening these deflation fears. At the same time, Shery, we've been talking about the fact that China's top leaders have pledged to strengthen fiscal support, emphasize the importance of economic progress. The Politburo also said that monetary policy will be stepped up appropriately. Alicia Garcia-Herrera is the chief Asia-Pacific economist at Natixis, joins us now. Alicia, no doubt you've been watching just as closely the messaging from the Politburo. What do you make of that against the backdrop of the data that continues to show perhaps more weakness than what a lot of us were expecting?
Well, I wouldn't read so much stimulus out of the statements, because it seems to me that China is increasingly wary of too much of anything in a nutshell. I think the idea of having a big stimulus and additional debt piling up at a time when Moody's has just downgraded China is something that I think is clearly not in the cards. And on the other hand, I think on the monetary side, they're well aware that they will have more room thanks to the Fed. So to me, what China needs is time, and we saw that with the delayed third plenum. They need to figure out, and Xi Jinping's latest statement on how difficult it is for China to move on in its developmental stage. You said it all. It's just very clear that they need to think of something. I think for me, they need to think of a fiscal reform, not necessarily a fiscal stimulus. They need to figure out how to feed the local governments, what kind of taxes the local governments need to avoid potentially even defaults at the local level. So this is more than stimulus, in my view, but that indeed the World Economic Program shows some kind of, okay, let's breathe and do something more relevant. And that's what it is. It's not a big stimulus.
And Alicia, I think what you say goes to the fact that a lot of these problems are structural and it's not just a less complicated cyclical slowdown, right? If you're underwhelmed by what the Politburo readout says, does that mean you're also managing expectations for the Central Economic Work Conference, which we would also expect to happen this month?
Exactly. So the readout, and that's exactly what I meant to say, that the readout really is, in a way, framing our expectations. There is not going to be a big stimulus. They would have said it differently. It is really more about, okay, we're going to do the fiscal needed to avoid a cliff in 2024. And we know that because there was stimulus in end of 2022 coming from all of this additional bond issuance that they need to now basically rework out so that there is no major stopping growth. But that's not a stimulus. It's just basically keep on doing what they had been doing to avoid a fallout in growth. So I'm not expecting anything bigger than that in the World Economic Program, indeed.
Alicia, it was really interesting to see this year that despite the pressure on the Chinese economy, financial assets across the region seem to have sort of decoupled from Chinese financial assets, not to mention that their economies in the region also seem to be rebounding, whether it's trade and semiconductor exports and other areas as well. Is this trend going to continue for other economies in the region in 2024?
Yes, absolutely, because we already see it in portfolio flows. I mean, there's inflows into India and there's outflows from China, and that's going to continue because, in a way, the Fed easing helps those markets even more than they do help in China, because basically of capital controls in China. So I think what's going to happen is that, and we already see that in Latin America for that matter, we see a lot of top portfolio flows betting on basically bigger yields in domestic currency in countries that had suffered from the Fed. So this is the year of those EMs. And that might not include China. At least it hasn't included this year, and it's very hard to see that happening without a big stimulus, which is our baseline scenario. So yes, more decoupling, better for South Korea because of the semiconductor cycle, even Taiwan for that matter. All of that is going to create additional decoupling in the performance of financial assets in Asia, in favor of India, South Korea, you name it, and again, against the backdrop of a still struggling China.
So, Alicia, to your point earlier, it's really about also the expectations that the Fed is going to ease, that it's not at least going to tighten further. But how important is it when we head into 2024, when a rate cut is very much priced in, the reason why it's cutting, whether it's just because cooling inflation is actually leading to that really Goldilocks scenario for the Fed, or because the economy is really softening too fast? Where do you see the Fed headed when it comes to rate cuts, and the motivation behind why they cut?
Great question. If it were because of growth, I wouldn't be saying what I'm saying. Is we are on a deflation type call here at Natixis, and that means that we will have a lot of cuts next year. 150 for the Fed, 125 for the European Central Bank, only because inflationary pressures are really going to come down, and they have come down. It's only a continuation of that process. For Europe, this is inflation down to 2%. So with that, I think growth will be 1.2 for the US and 1% for Europe. That's a scenario where Asia should not worry about, because it's growth less inflation, and much lower rates. So it's very good for markets. The key question mark is obviously China.
Does it also make BOJ policy a little bit easier if we have a more solid footing for the Federal Reserve? I mean, there's been so much speculation that the BOJ will need to move away from negative interest rates. When does that happen?
Well, our call is basically May, June, so right after the monetary review and the wage negotiations. We are seeing now wage data basically negative in real terms. I think the BOJ wants to keep what I would say keep face. I mean, they've said they want wage increases, and I think it's fair to say that they won't move before they have evidence of that. And if they don't, at least they have the monetary review. So, either or. Doing that before, I think there's no need, because the Fed is going to give them space. The dollar is going to give them space. We already see a stronger yen. So in that regard, I think they can move out, which I think they will, out of negative rates in a more elegant way. I mean, either with wage increases, or with the review basically saying that era is over, as it is over everywhere in the world, for that matter.
Alicia, next year, what are we not talking about that we should be? What do you see as the biggest risk for 2024 for Asian economies?
I'm afraid that we're kind of relaxed on the geopolitical front after Biden's Xi, but we should not. I think these tensions are coming back. We already see kind of disagreements on the understanding of what it means to have a peaceful environment in the region. The EU-China summit really ended, if not in tears, actually in despair, because nothing was decided. I think this doesn't bode well. We had Turkey already imposing restrictions on EVs, Europe too. I mean, it is very clear that trade tensions, because of a very large still trade surplus for China. We had data, again, very negative on imports. And the US basically leading that, this idea of, okay, enough is enough, is going to put a lot of pressure on our markets next year again.
Alicia Garcia-Rivera, always great to get your thoughts on a very busy week for economic data. Chief Asia Pacific economist Anna Tix is, of course, as we head towards those central bank decisions as well. Still ahead, we'll hear exclusively from ARM CEO Rene Haas and how the firm plans to become essential to the generative AI revolution. But first, tensions rise between Israel and Russia as the war rages on in Gaza. An update on that conflict next. This is Bloomberg. You're watching Daybreak Asia. Israeli Prime Minister Benjamin Netanyahu has criticized Russia's cooperation with Iran in a 50-minute phone call with President Vladimir Putin. Relations between Russia and Israel have been strained since the Hamas attack in October. Bloomberg's Alicia Diaz joins us now with the latest. Alicia, so what was accomplished through this phone call?
That's a great question. So a big undertone of this phone call is the increasing tensions, as you mentioned, between Russia and Israel. And a lot of that leads to this growing relationship that Russia has with Iran. From Israel's point of view, they say that Iran has helped train some of the Hamas militants. It is yet to be seen whether Iran had any intelligence of the October 7th attacks, but that investigation is ongoing. And so the point of this call really was for Israel to express some of its discontent. From the Russia point of view, their readout said this was just about them expressing, a need for humanitarian aid. So it'll be interesting to see how the tensions evolve between these two major players over the next coming weeks.
There's a pretty big gap when it comes to the ability to get more aid to Israel and Ukraine from the US. We know that a lot of congressional leaders were looking to try and tie this to the minimization of civilian casualties. What's going on now?
Yes. So there is this big impasse within the U.S. Congress. The U.S. did make a decision to fast track some munitions to Israel, which will have to overpass that typical congressional approval that usually comes with sending military aid overseas because the U.S. says this is an emergency. But in the meantime, there is this big gap. And so Republicans are saying that they want stricter border aid. Meanwhile, Democrats are saying they want to come to some kind of compromise and they aren't willing to reach that given what Republicans are proposing. And that is often stricter asylum policies. And so this is, of course, a conflict that has gone on for decades. And Congress is expected to leave at the end of this week. And it's unclear whether or not they'll be able to get some of this legislation through before yet another government shutdown deadline in January.
Despite this Biden administration backing for more aid for Israel, we have seen its rhetoric around civilian casualties in Gaza strengthen and become more critical of Israel. What are we seeing in terms of that relationship?
Yeah. And so even amongst lawmakers in Congress, broadly, people support sending aid over to Israel, but there has been a few more key players stepping up saying they want even conditions for sending aid. And that's something that likely won't be passed, but it does speak to the impact of the humanitarian conflict in Gaza right now, that there are some Democratic lawmakers saying that that is something they would hope for. Even the Secretary of State, Antony Blinken, is saying that he sees a gap between Israel's intent and the actual impact on civilians in Gaza. And so this strengthening rhetoric over the past couple weeks of ensuring that innocent civilians are not in the crossfires, I think speaks to what is at stake in this conflict going forward.
And of course, we continue to watch this backlash towards high-profile college campus leaders who testified in front of Congress about anti-Semitism. In fact, Bill Ackman just tweeting that he's penned a letter to Harvard's governing boards over the weekend. We've already seen, increasing pressure on Claudine Gay, and of course, Liz McGill's resignation has added to that. What's the latest? And I guess, what are we expecting in terms of the next steps that this is going to evolve into?
Yeah, as you mentioned, Liz McGill was a big development over the weekend, her ouster, and it'll be interesting to see what comes next. There is a laundry list of major names who have spoken out against the leadership of Harvard, and then some who have even pushed for the ouster of the leadership of MIT in light of those congressional testimonies. Like you mentioned, Bill Ackman, the White House even released a statement saying that this was not up to their standards of what is acceptable. And so it's pressure will continue to grow in the coming days. Harvard's board is expected to meet, and it'll be interesting to see how this pressure evolves.
Bloomberg reporter Alicia Diaz there with the latest, and you can get a roundup of some of those top stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can get that at Daybreak Go. It's also on the mobile. In the Bloomberg Anywhere app, you can customize those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg. CEO Rene Haas sees a company proving as essential to the generative AI revolution as it's been to smartphones. Haas spoke exclusively with Bloomberg on how his role has changed since Arm's $54.5 billion IPO earlier this year.
We've been public now for a few months.
Yeah.
So I would say I feel like the eyes are upon me a little bit more than they were prior. But on the other hand, I try to think about it in terms of the future of ARM is really not measured in what we are today. It's what we're going to be in a few years. I spend most of my time thinking about where ARM is going to be 3 years from now, 5 years from now. So on one level, yes, it's changed because the eyes are on us. We're a public company. We have to meet our expectations. We have to do exactly what we say we're going to do. But on the other hand, I'd like to think maybe not so much change because I'm thinking about 5 years away, just like I was before the IPO, same way I'm thinking about it today.
And how do you balance the demands of investors in the company now, those new investors, and the legacy investors, and of course, Masayoshi Son, SoftBank being the big force, gravitational force there? How do you balance those demands?
So ARM is really a company that is hard to look at quarter to quarter because the technology we're working on today is really technology that's going to end up in products 3 years from now, 4 years from now. So while the financial results are important, they're really the results of strategies we put in place a number of years ago, which were quite successful. This is when we created our Neoverse product line for the servers, we created our automotive product lines, and you're seeing those things really come to bear. So for us, what we try to do is just make sure that the investors understand that while the near-term results are very important, it's really also important to really think about the long term and where we're going directionally.
ARM was set up in the 1990s. You've been the building blocks of our digital globe, digital world, digital economy since then. And now we're at this point where we're focused on generative AI, and that is reshaping this digital ecosystem that we now live in, or that we will be living on. What role do you see ARM playing in that transformed digital space in the years ahead?
Yeah, so ARM in the 30-plus years has just been foundational to computing in a way that no other computer architecture before it, and I dare say after it, has been. 70% of the world's population touches ARM today in some way. We were well known for smartphones, and before that, non-smartphones, feature phones, if you will. The ARM of today is not only much more diversified around, as I mentioned before, data centers, automotive, IoT, but now as AI and AI workloads are finding their way into every single application, whether it's your thermostat or your data center, ARM will be there. So I think for us in the upcoming years and decades, ARM will be foundational to everything going on with AI.
So you can assure investors that you will remain, you're essential right now to this digital world that we live in. You will be essential in that generative AI reshaped world in the years ahead. You will continue to play that essential role.
You can't run AI without ARM. It's foundational. And AI is going to find its way into every single electronics device that we use. Again, whether it's the smallest device in your home or the largest data center that sits out in the wild.
Every AI executive that I speak to, whether it's DeepMind or Cohere or Inflection or others, say the scramble for compute is front and center, along with the fight for talent. How do you see that fight for compute going forward?
I do think for the next number of years, we are going to see a increasing demand for more and more compute. Now, I think what's also going to drive is a high degree of need for power efficiency, because these data centers require hundreds of watts, megawatts, up to the gigawatts of type of energy. We don't produce that much energy as a planet. We are having limitations relative to fossil fuels, limitations to sustainable. So a rush to get to power efficiency around these compute models is going to be very, very significant. That's great for ARM because the DNA of our company is around power efficiency.
CEO Rene Haas speaking exclusively with Bloomberg's Tom McKenzie. Much more to come here on Daybreak Asia. This is Bloomberg. 2024 could be a make-or-break year for Australian Prime Minister Anthony Albanese as elections loom. His approval rate has plunged to 40% from 62% last year. Our Australia government reporter Ben Westcott joins us now from Canberra. So, Ben, how is the PM sitting as he reaches just about the halfway point in his term after some disappointments this year?
Yeah, absolutely, Heidi. So, I mean, anyone who remembers this time last year would remember a leader who was ascendant and who was planning to spend several terms in power. But now things are a bit grimmer for Albanese after the past 3 months. It started with the failure of his signature voice to Parliament referendum in October, and then obviously 2 months. After 2 months, he's had rising inflation, not rising, but certainly stubbornly high inflation, which has which has led to the Reserve Bank increasing interest rates, and then now this immigration crisis with the High Court, which has seen detainees release them to the streets of Australia and has led to a chaotic 4 weeks in Parliament. So given all that, his party is now drawn level with the opposition centre-right Liberal National parties in the polls, and with Albanese ends 2023 on a point which is far worse than the previous year.
Ben, so how important will 2024 be for the Albanese government?
Yeah, it's really going to be crucial to Albanese regaining his fortunes, particularly since 2024 could potentially be an election year for the government. Albanese might call an early election at the end of next year, given depending on how inflation is trending. But before he reaches that point, he has to deal with the stage 3 tax cuts, which were introduced by the previous government to deal with index bracket creep for the government. So given all of that, he's going to have to steer the ship back onto a course which puts him ahead of the opposition if he's planning to introduce new legislation for next year.
And of course, one of the sort of, I guess, unpopular aspects of the cost of living crisis has fallen on immigration, right? We've seen that in New Zealand as well, and it's a similar picture for Australia. Are we seeing changes to the immigration strategy and policy?
Yeah, so a new immigration strategy is going to be released today by the Albanese government, and that has a number of aspects to bring inflation, potentially even halve it below the record levels we've seen over the past year. So the economic figures released later this week will show 510,000 net migrants to Australia over the past past financial year, that is. And that's not only 100,000 more than was expected in April, but it's about twice as many as usually Australia would expect in a year, at a record high. So because of that, that number is causing consternation in Australia, particularly amid a housing crisis. So the government's announced this strategy today in the hope of bringing that back down. Things including a crackdown on student visas being abused to bring in low-skilled migration, and special visa classes to lure in those migrants, including people earning over $130,000 a year who will be getting a special 7-day visa pathway.
Bloomberg's Australia government reporter Ben Westcott there joining us from Canberra. And here are some of the other political headlines that we're following around the world. The Egyptians began voting Sunday in a 3-day-long election with President Abdel Fattah el-Sisi all but certain to win a third term, even as the North African nation grapples with its worst economic crisis in years. The most pressing issue for Egypt's electorate is the soaring cost of living, with inflation running at an almost 35% clip after 3 currency devaluations since early last year. Javier Milei has been sworn in as Argentina's president. In a message to the nation, he warned Argentines will have to endure additional pain while he works to pull the country from an economic crisis. Milei has pledged spending cuts and said the economy will worsen before turning around. The leader's cabinet pick triggered a rally in the nation's dollar bonds and stocks. Chinese and Philippine vessels faced off in multiple clashes in the South China Sea over the weekend as tensions over maritime territory continue to escalate. The Philippine Sea Task Force says its vessels were damaged after being directly targeted by a Chinese Coast Guard ship with a water cannon. China's Coast Guard says the Philippine boat ignored warnings and deliberately collided with its vessel.
Shery, take a look at how we're trading so far. Just about 35 minutes or so in the start of cash trading here in Sydney. We're seeing a little bit of upside, just about 0.2% there. This as we could see some measured gains going into the rest of the Asian trading session. We are seeing, of course, a big week ahead for central banks with the Fed, but really a number of other major decisions affecting just about 60% of the global economy. Here in Sydney, we're seeing energy seeing particular strength, up by just about 1% at this point. We're also seeing industrials as well as consumer names doing quite well so far in the early part of the session as well. New Zealand looking pretty flat at the moment. We're talking about immigration before. We've heard from the new Prime Minister, Christopher Luxon, saying that the record level of immigration in New Zealand is unsustainable. They expect that to slow. We're also seeing Singapore Nikkei futures up by just about 1.2% there. This as we continue to really watch for what happens with these central banks, given how intensely the pricing has really changed over expectations of rate cuts. Bond traders in particular bracing for potentially more volatility this week. We're also getting readings for US consumer prices, retail sales for November, a compressed schedule when it comes to Treasury auctions, as well as, of course, as I mentioned, the Fed's final meeting of the year on the docket as well. So a very, very busy week as we head into the second part of September. December, I should say. S&P futures looking marginally higher, about 0.1% at the moment. Also watching dollar yen actually sitting at that 145 level at the moment. Of course, some of that work has been done by the weakness that we've seen in the greenback. The yen at the moment trading as we see the dollar looking pretty mixed in the early part of Sydney trading and pretty range bound as well as we get into those policy decisions there. Dollar yen ending the Friday up about 0.6% to trim that fourth weekly decline to just about 1.3%. Also watching the Aussie dollar, we're seeing a little bit of weakness there. We had that weekly decline to about 1.5% and snapping that 3-week rally, but we heard from NAB a little bit earlier suggesting that there's really more of an upside risk there for the Aussie dollar, given the improving fundamentals and given the dovish outlook for the Fed. Well, coming up next, we'll be getting the market outlook when it comes to Japanese markets. Neuberger Berman's Kei Okamura joins us. Investors are watching the next steps when it comes to the BOJ. This is Bloomberg.
It's time for Japan Ahead on Daybreak Asia. Machine tool orders for November due later on Monday. Data in October fell a revised 20.6% year-on-year. We're also watching for the November money supply expected in the next few minutes. M3 stock rose 1.8% year-on-year in the previous month. Also, Asahi newspaper now reporting the Japanese Prime Minister Kishida will fire 15 officials, including his trade minister, amid a scandal over slush funds. Trade Minister Yasutoshi Nishimura would be the second top member of the cabinet to be replaced, following Chief Cabinet Secretary Hirokazu Matsuno. Haidi.
Yeah, let's get some more from our politics reporter. Isabel Reynolds joins us out of Tokyo with more on this funding scandal that has really just widened, right? What are we expecting from Prime Minister Kishida?
Right. Well, as has just been explained, the scandal is broadening wider and wider, and some people are saying now it's probably the worst financial scandal in the Japanese government since the 1980s. There was a famous insider trading scandal at that point. Japanese Prime Minister Fumio Kishida may opt to, according to media reports, to replace 15 ministers from his government. So those are not just the sort of top ministers, but also the junior ministers, the vice ministers, all of the the ones who belong to the so-called Abe faction within the party, which is the one that seems to have been most deeply involved in this plan to sort of kick back funds to lawmakers and not have them declared in their campaign funds so that they effectively can be used for anything.
What will this mean, Isabel, for his administration, given that Kishida has really been struggling with low public support?
Yes, I mean, he's already an extremely unpopular prime minister. Some polls have already shown that he's the least popular prime minister in more than a decade. So he's not starting from a good point. I think he's probably trying to bring this under control by firing these people who are mostly deeply involved. But there have been reports that this practice spread beyond that faction into other factions, other parts of the LDP. So it's very unclear where this will end and how far it will affect the whole party itself. On the other hand, if you look at the opposition in Japan, support for them is still extremely weak. So the fact is they don't really have a rival. So if it comes to an election, is there anyone who can take over? That's also very unclear. It's all a bit of a mess at the moment and very fluid.
Politics reporter Isabel Reynolds in Tokyo. Despite what's happening in Japan's political landscape, we have seen really big upside when it comes to the stock market in Japan, with the Nikkei gaining more than 20% already this year. Of course, there's been a lot of optimism about valuations, also about corporate governance, and a series of reforms in the Japanese market. So our next guest says that Japan is finally emerging from its lost decades as the government, companies, and shareholders all work together. Kei Okamura, Senior Vice President and Portfolio Manager at Neuberger Berman, joins us now. Kei, great to have you with us. We just heard from Isabel how much of a mess the political situation looks to be in Japan. And I remember I lived in Japan for 5 years before the Abe administration, and I saw, I think, as many prime ministers go through this revolving door. If we have more political uncertainty in Japan, what will this mean for the economy and the markets?
Yep. Well, good morning, and thanks for having me today. You're absolutely right to point out that these political issues are never a good thing for markets, especially given that it does lead to some uncertainties about the outlook for Japan. That being said, if we look at the various reforms that the government has pushed through in 2023, starting with the TSC, going on to the Financial Services Agency's Corporate Governance Action Program, the new revised M&A guidelines from the Trade Ministry, these are rules and regulations and guidelines that will be very hard to unwind and roll back. And as we've been seeing in the markets in the last several months, many companies have started to really work for the interests of minority shareholders to unlock value and to raise capital efficiency. And we think these things will be here to stay. So going forward into next year, it is to be determined how this political situation shapes up. But as long-term investors, I think we remain hopeful that the direction of travel for this market is in the right direction.
Is that also your thought when it comes to Bank of Japan policy? Because we're now starting to factor in a potential change, especially perhaps the last central bank really turning positive in terms of interest rates as soon as this month is now market pricing. What will be the implications of that momentous change?
Yes. I think this is going to be a pretty big change for the Japanese economy, certainly. We have to think, though, that this is not a situation that has sprung up overnight. The Bank of Japan has said that it is looking to normalize its monetary policy going forward. And given the pickup that we're seeing in inflation, especially in the last sort of 6 months to a year, I think it's quite likely that the Bank of Japan will move to shift monetary policy. Whether that's going to happen during this month's meeting or perhaps the meeting after, we have yet to see what the outcome will be. But at our firm, we continue to believe that the Bank of Japan will normalize monetary policy. It'll likely start with the yield curve control and possibly at the same time with negative interest rate policy, and then from there move up to positive interest rate policy. What that will mean, though, for us is that this will be, for certain sectors, quite attractive, like financials, where we do think that several institutions in that market will likely see a more conducive business environment to make profits. And then I think at the same time, for the rest of the economy, I think as long as the Bank of Japan continues to take a measured approach in terms of its monetary policy tightening, then this should mean that the Bank of Japan will remain weak and then gradually appreciate, which according to the management that we're speaking to have told us that they're quite comfortable with the yen appreciating as long as it happens in a pace that is not too disruptive to the business, as long as there's no volatility.
What levels of the Japanese yen are we talking about as we see this change from the BOJ? Because we saw really that appreciation last week just on speculation alone.
Sure. I mean, at our team, we're very much long-term, bottom-up investors, and our focus is on, the fundamentals of the company. So we don't really have a view in terms of where the yen will be in 6 months to a year's time. That being said, the companies that we're invested in, the models that we employ to analyze these companies are looking at the yen to appreciate next year. Certainly, we're not looking at, say, 120, 110, but, somewhere in between there and where we are today, I think would make sense. And then if we take a look at those figures, most of these companies that we own have been able to make plentiful profits in the past with those levels, so we're not too concerned. And I think it is important that in the mid to long term, we continue to focus on companies that will really prosper, whether the yen is at 70 or whether the yen is at 145. And what we mean by that is that I think it's important that companies are able to manufacture in their end destinations so that the top line matches the cost structure, and therefore we don't see too much disruption in terms of how the company generates profits, irrespective of where the currency is.
Okay, does that include also smaller companies, small and mid-cap companies? Because we're not only talking about a stronger yen, we're also perhaps talking about higher borrowing costs, although I wonder at what level will that become an issue for these companies?
Sure. I think for Japan at the moment, the issue of higher borrowing costs is not too big of an issue. I mean, we're currently at the moment, the benchmark interest rate is in negative territory, whereas the rest of the world and the US and Europe are north of 4 and 5%. I think for Japan's economy, what will be even more important is how positive wage inflation continues to sustain itself in the mid to long term, and then whether or not consumer prices will be able to normalize it between 2 to 3%. And this will be particularly important for the SMID market that you were referencing. I would also add, though, that going into 2024, this is really going to be a testing year for the entire Japanese market. And we are particularly interested in the Japanese equity market because we think that there's going to be winners and there's going to be losers. Especially when it comes to the winners, these are the companies that will be able to continue to pass on rising costs, will be able to continue to maintain that pricing power, irrespective of where the consumer price inflation will be going forward. The losers, on the other hand, I think they will start to have difficulties trying to maintain pricing power in this type of environment, and I think that might not bode too well for share prices going into the mid to long term.
Do you have a view on where those stronger companies are concentrated in terms of sectors or just sizes of these businesses?
Sure. Well, we take a very bottom-up approach across all of our companies. But for instance, if we were to look across the sectors, we tend to remain overweight in, say, information technology, and then, of course, in terms of financials, the equipment side of healthcare. If you look at these companies, these are really, if you look at these sectors, these are dominated by companies that have real global market share, that they have technology, they have the moat, they have strong brands, and they have a really big presence in some of the growth sectors of the economy. I think that's an important part of the company to be able to drive growth and at the same time maintain pricing power. The parts where we don't have too much exposure yet is in the likes of, say, energy or utilities, where we do have some concern about the mid to long term, about whether companies in those respective areas will be able to manage their own sort of earnings visibility going forward. A lot of these companies in these sectors are susceptible to commodity price fluctuation or the government's energy policy mix guidelines, and therefore we would try to stay away from that. But in the sectors that I mentioned to you earlier, we do think that going into next year, they will likely see a very, very good year, just given the changing macroeconomic environment.
Keo Kamura, really great to get your insights. Senior Vice President and Portfolio Manager at Neuberger Berman, doing a deep dive into the Japanese economy and markets. Of course, we have been seeing the Japanese yen seeing a little bit of strength last week, but we'll continue to watch where that expectation of BOJ policy goes from here. And you can catch Japan Ahead every week. That's every Monday at 8:40 a.m. if you're watching in Tokyo, 7:40 p.m. Sunday in New York. Bloomberg subscribers can watch us live on the terminal using TV Go as well. This is Bloomberg.
Well, baseball superstar Shohei Ohtani's record $700 million 10-year contract with the Los Angeles Dodgers may just be a boon, not just for him, but his corporate sponsors as well. For more, Bloomberg's Hideyuki Sano joins us from Tokyo. And Hidey, what impact do you see from Ohtani's record deal that potentially plays out when it comes to Japanese equities?
Hi there. A lot of people will be talking about Ohtani's big deal, and I guess one of the main potential beneficiaries will be his corporate sponsors, which include MUFG, the financial group, cosmetic maker Kosei, or Japan Airlines. And another potential segment is sportswear makers. There are not many, but there are a few Japanese sportswear makers. Now, it's not entirely clear exactly what kind of benefits Ohtani's big deal will bring to the bottom line of these companies. Even if Ohtani becomes popular, that doesn't necessarily mean those companies are also getting popular. But nonetheless, it's an uplifting news, so that is going to be probably positive for those companies.
And does it also help that we have, of course, seen some of the worst weeks for the Nikkei 225 in terms of how much upside this could actually provide for the broader markets? What have we seen in the past?
Yeah, the main factor that has hurt Japanese stocks was the yen. And the speculation about the Bank of Japan possibly changing its policy much earlier than previously thought. Now, there's discussion going on in Japan, and probably also outside Japan, that whether markets have rightly interpreted the BOJ's comments. And at least the signs in the US that the economy is going to a soft landing rather than hard landing seems to be helping the broader global shares, and the Japanese shares are likely to rebound today, and that is also supportive for the market.
Yeah, we'll be watching those stocks and those sponsors, Japan Airlines, Kosei Seiko Group as well. Hideyuki Sano in Tokyo. The market opens in Tokyo and Seoul are next. This is Bloomberg. This is Daybreak Asia. We're counting down to Asia's major market opens as we head towards a series of central bank decisions this week, including from the Fed, the ECB, BOE, and PBOC. And Heidi, of course, is coming at a time when we've heard from China's top leadership that they might strengthen financial fiscal support.
That's right. Whether that's going to be impressive in terms of what markets are building up for expectations of that fiscal push going into next year, they could be disappointed, right, given that we're also looking ahead to the Central Economic Work Conference that should take place in December, where they set those economic and macro goals for next year. So that's one thing that we need to watch out for. The other, of course, Shery, as you say, is really the 60-hour window where we get all these major central bank decisions.
And also coming at a time when we got that stronger than expected U.S. jobs data, really sending the U.S. dollar higher. On the other side of that trade, take a look at the Japanese yen, which is really holding at around that 145 level against the greenback. And you're looking at the Nikkei and the topics now come online to the upside of about 1%. Of course, this has to be put into context because just last week we saw one of the worst weeks for the Nikkei 225 so far in 2023, given the resurgence of the Japanese yen on speculation that the BOJ was moving towards really ending that negative interest rate policy. And you see the 10-year JGB there holding at that 0.79% level. Take a look at what the Kospi is doing at the moment, because we had seen it really rise to that 1-week high, and we're getting also trade data for the first 10 days of this month, and its growth of 3.3% year on year. When it comes to the imports numbers, a fall of 15.3% year on year, which leaves the trade deficit for the first 10 days of this month at $1.41 billion. But suffice it to say that we are seeing an improvement on economic data out of South Korea, especially when it comes to those trade numbers, exports accelerating in November on the back of a rebound in semiconductor demand. Of course, such a key market for some of these economies in Northeast Asia, Heidi.
Yeah, and we are setting up ahead of this key week, aren't we? Take a look at how Australian assets are trading at the moment. We're seeing 10-year yields rising about 6 basis points there. The 3-year order also adding about the same this morning. A couple of headlines that we're watching for: the plan to cut record high influx of immigration by cracking down on student visas and unskilled migration. We're also expecting that mid-year budget update expected to reveal a lower than expected level of debt, according to Treasurer Jim Chalmers. We're also seeing Kiwi 10-year yields climbing about 4 basis points in the morning's trading as well. Taking a look at the Aussie dollar, we're trading at 65.81, so clawing back some of that weakness that we did see. But of course, a lot of this will really come down to what we see when it comes to the Fed and how Treasuries, as well as of course the dollar, reacts to that. The greenback is set for that. We did see that weekly gain, I should say, for the greenback going into the end of last week. This is a picture when it comes to Treasury yields at the moment, pretty unchanged in the early part of the trading, at least when it comes to the trading of the futures session. We're seeing muted moves at this point as well. They did drop on Friday. That strong jobs data spurring traders to kind of pull back a little bit on their rate cut bets that have been really intensifying in the past few days and weeks. And of course, we're seeing that slide in Australian bonds there as well. When it comes to that surge in yields, we are seeing traders somewhat managing expectations for the Fed to ease policy aggressively next year after better than expected jobs numbers came through there. But it is really that big week from Washington to Frankfurt to London and beyond. These are the final decisions of the year for these major central banks this week. For what's at stake, let's bring in Daniel Lam, who's a head of equity strategy at Standard Chartered Wealth Management. Daniel, great to have you with us. Do we need to see markets sort of taking a breather in terms of managing these expectations?
Well, last Friday's non-farm payroll number beat expectations. So that kind of adds a little bit of, should I say, small confusion in the markets, right? Because people were expecting that, from March next year, the Fed would be starting to cut. But now it's not so sure anymore, because the Fed is probably going to be holding this time, and they're going to cite, data watching again, right? Because non-farm beat, and there could be, some of the data that could be beating over the next few weeks, in which case this would probably delay the rate cut expectations, right? So people could be waiting and seeing at this moment in time because of that.
When it comes to some of the other central banks we're watching, what sort of, I guess, divergent opportunities do you expect to see, depending on whether we see some of these policymakers sort of hang back a little bit from where market expectations are for the Fed?
Well, basically, earlier in the program, you referenced the BOJ. Okay, so the BOJ is, we believe that they are probably going to be tightening fairly soon. Okay, because of the fact that their economic data has been relatively strong, and the inflation path seems to be on par with what they're expecting. So that could be one that can move the markets a little bit in 2024, and we're expecting that the dollar yen is probably going to strengthen around to 137 to 139 over next year. And that could mean that the rally that we've seen in Japan, you could see some kind of stalling or some kind of sector rotation rather. Okay, so sectors like the banks would be doing pretty well in that aspect. So in Japan, it's not about playing the beater anymore. It could be about the sector selection, and that could be opportunities for investors.
Are there opportunities for China as well? We might see a bit more fiscal support going into 2024, but there is also the likelihood that investors are disappointed ultimately by what policymakers come through with.
Yeah, so China is an interesting one because from a flow perspective and from a technical perspective, you saw that the Hang Seng Index basically went from 22,000 at the beginning of the year to around 16,000 at this moment in time. But it's interesting to note that over the last few weeks, the volume, the turnover in the Hong Kong market actually has increased quite a bit. It's actually around 40% of what we've seen over the last 3 months. So it seems that there is a change of hands, right? The weak hands were probably capitulating, right, over the last few weeks, and the money goes, the stocks goes into the hands of the stronger holders. So when that happens, it seems that around these levels there is reasonable level of support. It seems. So whether the stimulus, potential stimulus this week materialize or not, it seems that the market has relatively limited downside from here. So in Q1, they could see, some potential upside action in the Hong Kong China equities because of that.
What about expectations when it comes to European equities? Do you see further demand? Do you see a further rally when it comes to German equities in particular, depending on what we hear from Christine Lagarde this week?
Yeah, so Europe, basically because, over in the US, the recession probability, has somewhat decreased. It is probably going to be spilling over to the rest of the world. Okay, so we believe that Europe could be helped by that fact, and it seems that there are a number of selected large cap names that are doing relatively well in Europe, and roughly about 8 to 10 of them, and they are the ones that are contributing over half the returns in the European equities. And right now, the fundamentals of those are looking relatively okay. They span across different sectors, actually. So, at this moment in time, there could still be some more upside to European equities, we believe.
What about emerging markets?
Okay, so we talked about China. So China, of course, is very much linked to, the rest of the emerging markets very much linked to China. The domestic-oriented plays, those, that generate the returns from the domestic activities more than the others, would probably be the ones where investors will still be looking at. Okay, for example, India. So India remains a strong structural story because 70% of their working class 70% of the population is still in the working class, is still working, right? So that is very strong demographics. And also the consumer side is growing very strong. So by 2050, 40% of the global middle class is expected to come from India, which is, a hefty stats. So right now, if you look at the Indian market, they were helped by the favorable recent state election results. So they're looking pretty good at this moment in time. Valuation has always been expensive. Okay, and because of that, you could see some potential stalling of the rally. But on the pullbacks, it could be interesting to add.
Daniel Lam, always great to have you with us, Head of Equity Strategy at Standard Chartered Wealth Management there. Well, coming up, Israel and Russian leaders speak as tensions deepen over the conflict in Gaza and Moscow's growing ties with Iran. Plus, we get the transportation outlook with HSBC and their prediction for 2024 as the holiday season gets underway. This is Bloomberg.
You're watching Daybreak Asia. China's top leaders have pledged to strengthen fiscal support, raising economists' expectations for a growth goal of around 5% for next year. Let's bring in our global economics correspondent, Enda Curran, in Hong Kong. Enda, so what sort of support are we talking about, and how much of a difference will it really make to the Chinese economy?
Well, it sounds like the government is talking about more fiscal spending. The statement that came out via Xinhua from the Politburo said that economic growth is, by all accounts, further up the agenda maybe than it has been. Fiscal policy will be a big part of it. They didn't really put much of a focus on what the central bank can do there. So all the indications are more stimulus will be coming. Maybe they will be more relaxed on the deficit side of things. It suggests they're looking at a growth target of 5% again for next year. This year's growth target of around 5% is probably going to be met, mostly helped by the base effect from a year ago and given what was going on with the lockdowns and everything else anyway. But if they do come in with 5% for next year, that would be harder to meet, and it suggests it might be even more boring than anticipated right now. So, it's not massive stimulus. It's important to state the messaging that came out over the weekend, they're not suggesting a kind of a gangbusters spending spree, but it does sound like they are putting more of a focus on growth than they have been. It will be more on the fiscal side, and that's going to be very important for the global economy if 2024 is a stronger year for China than it has been.
And we usually get the Central Economic Work Conference in December as well. What are your expectations, given the Politburo readout, in terms of what the macro and economic targets and priorities will be?
Well, I think, it's been such a disappointment to China economic story this year. Remember, this was meant to be the year of the big rebound, post-COVID zero, Chinese spending, Chinese tourists, Chinese consumption, and none of that really played out. The investment sentiment towards China is so negative, both in terms of portfolio flows and, of course, actual fixed asset investment. Companies around the world looking for different options. So if the messaging does come out of the authorities like we got over the weekend from the Work Conference and the other channels, that they are now looking back at putting a focus on growth again, that might say, perhaps China's getting serious by trying to push past this real estate funk that they're in, get consumers going again. But I think regardless, there's a kind of a a structural take on China now, that security is the focus there. The political backdrop is one of geoeconomics, geopolitical tensions with the US and other key rivals, and that's going to continue to cast a long shadow over the growth story. And I think sentiment towards China, even if we do see a focus in growth and allowing the deficit to go up above 3% again, I don't think sentiment's going to turn around in a hurry, regardless of what the World Conference says.
And then when it comes to the PBOC, we have seen monetary support come through, boosting liquidity instead of rates. Is that sort of the trend that we'll continue to see next year? And why not just cut rates?
Well, the statement over the weekend via Xinhua didn't really put much of a focus on the PBOC, really. As I said earlier, it's putting it back on the government spending side of things. And, as you know, most people would tell you China's economy probably doesn't need another interest rate cut. But they still have scope to do that. They still have scope to intervene in the money markets to try and ease conditions where they are. But probably what would help then next year would be if the PBOC and other major central banks are moving in the same direction. If they are starting to ease at some point, that might help them on the exchange rate point of view. But I think the story for next year is going to be about its government spending, of course support from the PBOC, but I'm not sure if they're going to be a central actor in trying to turn China's economy around.
Our global economics correspondent Enda Curran there in Hong Kong. Well, ARM CEO Rene Haas says tech firms with exposure to China run a very fine line these days. Haas spoke exclusively with Bloomberg's Tom McKenzie on how the chip designer is navigating these geopolitical tensions surrounding the sector.
I think, like most tech CEOs, we all run very fine lines these days. I think CEOs 10 years ago did not talk to government officials with nearly the frequency that we do today. So we comply with all the export controls, whether it's from the US or other parts of the world. China is a big market for us, as you said, about 20 to 25% today. China looks like the rest of the world, though, in terms of the ecosystems they build, the software that runs on the processors, and the markets that they want to address. So the big markets that are growing for us in China, unsurprisingly, are cloud and automotive. Automotive and EVs are growing very, very fast in China. You just have to travel to China.
I want to talk a little bit about ARM's place in the UK. ARM was conceived, of course, here in Cambridge in the UK. It's now obviously majority owned by a Japanese company, SoftBank, listed in the US. What role do you see the UK playing for ARM in the years ahead?
The UK is our home. It's our headquarters. It's where we were born, and we're always going to be here. So the UK is incredibly central to the future of ARM in so many ways. Probably our biggest bottleneck for growth is just getting talent in. But we are very, very committed to the UK. And again, the UK is going to be so critical for our future.
And the Prime Minister, the Chancellor, they want to turn the UK into the next Silicon Valley. Is that realistic, Rene? Really?
There's only one Silicon Valley, right? It's a unique area in terms of its ecosystem, the universities, and how the whole section works. Does that mean that can't be imitated or replicated on some level in other parts of the world? No, not at all. And I think the government here has been doing a fantastic job around that. And Cambridge itself is a very, very rich community of small companies, incubators, the universities.
What would you say to any incoming government, whether it's the Conservative government or a Labour Party government, that you would want to see happen in those first 100 days?
We're very committed to the UK. This is our home. We were born here. We intend to stay here. Please make it very easy for us to attract world-class talent and attract engineers to come work for ARM, because that is the single largest limiter that we will have for growth is access to talent. And if that gets any more difficult with a change in government that you described with the next election, that would be a headwind I would not want to have to engage on.
ARM CEO Rene Haas speaking exclusively with Bloomberg's Tom McKenzie. And you can get a roundup of all of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to DayBGo. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg.
Israeli Prime Minister Benjamin Netanyahu has criticised Russia's cooperation with Iran in a 50-minute phone call with President Vladimir Putin. Relations between Russia and Israel have been strained since the Hamas attack in October. Let's get more from Bloomberg's Bruce Einhorn. And Bruce, so what did we hear in this conversation?
So there was a call between the two leaders. It lasted for about just under an hour. In the call, according to Netanyahu's office, the Israeli prime minister talked about Israel's concern about Russia's work with Iran. Russia has certainly intensified its partnership with Iran when it comes to relying on Iranian drones in the war in Ukraine. The Kremlin, for its part, said that Putin spoke with Netanyahu about how Russia condemns terrorism, but says that there needs to be action to protect civilians. At the same time, this over the weekend, not at the same time, obviously, but Prime Minister Netanyahu also spoke with German Chancellor Scholz, with French President Macron, again, talking about the war. According to Netanyahu's office in his call with Scholz, Prime Minister Netanyahu talked about the need to continue the war. According to the German Chancellor's office, the German Chancellor spoke to the Prime Minister about issues such as protecting civilians in Gaza.
And Bruce, as the Prime Minister continues his war on Hamas, we have seen U.S. leaders trying to get more aid for Israel. What's the latest on that front?
So there are negotiations currently underway. President Biden has requested $106 billion in emergency aid for Israel, for Ukraine, and that also includes money for increased security at the southern border. There are negotiations underway. The lead negotiator for the Democrats, Chris Murphy from Connecticut, senator from Connecticut, says that currently Republican demands are what he called unreasonable. One of the Republicans, Senator Langford from Oklahoma, said that the Democrats are not serious enough about border security. Chris Murphy expects that the White House is going to get more involved in these negotiations this week. Time is running out because the Christmas break is coming up. In order to get this aid passed this year, they're going to need to step up. There are a lot of Republicans who are opposed to aid to Ukraine just in principle. And so there is the possibility that Republicans would just walk away from this. That's some leverage that they have with the Democrats in trying to force the Biden administration and Democrats in Congress to agree to restrictions on, say, asylum for people coming across at the southern border.
We continue to see the fallout when it comes to congressional testimony by Harvard, MIT, and Penn presidents.
Yes, so there was testimony last week widely criticized by people from all sides of the political spectrum. The three university leaders were asked about university policy regarding calls for genocide, gave sort of narrow legalistic answers, which didn't really satisfy their critics, who said that these universities are not taking anti-Semitism seriously in the way that they do other hate speech. We've seen already the president of the University of Pennsylvania has stepped down. The chairman of the board at University of Pennsylvania has stepped down. The MIT, Massachusetts Institute of Technology, has expressed support for its president. A lot of attention now is focusing on Harvard. President Claudine Gay, who has been subject to a lot of criticism, has issued an apology for her statements in Congress saying that words matter, weren't sensitive enough. We'll see how it plays out and whether she'll be able to keep her job. So far, the situation is very uncertain.
Congress Bruce Einhorn there. And take a look at how European futures are coming online in the Asian trading session after we saw that powerful rally continue into the Friday session. And we're seeing futures pointing to even more upside after European stocks hit their highest level in nearly 2 years. We had already seen a November rally that's extended into December, and the year-end gains are now approaching about 10%. And really those gains being accelerated on Friday after that stronger than expected U.S. jobs numbers, not to mention that we saw the likes of luxury and travel stocks gaining ground on expectations of more fiscal support coming from China. And of course, the big news this week in Europe is the expectation that the European Central Bank will maintain borrowing costs and keep them there until June. That's according to economists surveyed by Bloomberg. We'll have more on Daybreak Asia. This is Bloomberg. You're watching Daybreak Asia. Chinese stocks and yuan in focus as consumer prices fall at the steepest pace in 3 years. And the Politburo pledges a more targeted and flexible monetary policy. Let's get a preview of the market open in the mainland in Hong Kong with our Asia stocks reporter Jeannie Yu. Jeannie, we're seeing more of a risk-on tone in the broader markets across Asia. Can we expect some upside for Chinese assets given this expectation for more fiscal support as well?
Right, you're right. I think overall, people are still digesting the takeaways from the Politburo meeting contents, which was released after market close last Friday. I guess one of the key things people are looking for is whether the government is going to announce anything that's related to property going forward, because in the Politburo meeting, it didn't mention property at all. And we've seen the property developers plunging, at the end of the trading last Friday. So that's of course one of the key focus. But as you just said, the region has been on a risk-on mood, and also the people are still expecting Beijing to do more in terms of some easing measures on the physical and monetary side next year. So definitely this is something to look forward to. And then the other thing we are looking at is the Chinese government, the regulatory on the security brokers. They're trying to cut the commissions and to bring more money into the stock markets. So we're going to see whether that's going to boost the sentiment as well. In general, so people are still, trying to see whether there's more message from the government.
What's a risk of disappointment for these markets, though, particularly if we don't get an impressive, set of priorities or goals from the Economic Work Conference this month?
Yeah, I think the timing of the Central Economic Work Conference is still, as expected, and also, some of the key points, for example, about properties, people are still expecting the Chinese government to do a lot more. So right now, the physical spending, people are saying, about 3%, and then also the nominal GDP growth for next year, about 5%, is still, not enough for the property market. So, and that's one of the biggest issue for the whole Chinese stock sentiment. So if that's not going to solve, I don't think the property market sentiment or the stock market sentiment can be revived soon. You're also seeing the both China and also Hong Kong stocks, they're testing a lot of critical levels, which may indicate that we could see some, technical rebound, going forward, maybe this week or next week. But really, for the market to really have some long-term outperformance regionally, it still needs some policies.
Our Asia Stocks reporter, Gina Yu there. Take a look at the picture across Asia. We're just half an hour into the start of trading in Japan and Korea, about an hour and a half into the start of cash trading here in Sydney as well. Of course, a big week. Some early gains that we're already seeing going into Fed meeting week. Of course, not just the Fed, but also key US data, including CPI, as well as other major central bank decisions, including the ECB as well. The Nikkei 225 is up by just about 1.9%, so quite a strong performance there that we continue to see out of Japanese equities. When it comes to the segments, we're seeing essentially every single segment they're trading in the green, but tech, IT, industrials, healthcare and energy, just some of those subsectors that are performing high, that rallying beyond even 2% at this stage. The cost B also seeing pretty marginal gains, and we are seeing much more modest gains here when it comes to trading in Sydney. Some of those resources stocks are really being eyed today, given these fluctuating expectations of how much policy support, fiscal or monetary or otherwise, that we could see from China. New Zealand stocks are on the back foot. We did have an announcement or some commentary from the Prime Minister about what they see as unsustainable levels of immigration. That immigration strategy change is expected from the Australian government a little bit later on today as well. The broader MSCI Asia Pacific is up by just about 0.3%. We're also watching the sort of domestic politics of Japan as well in this session. Japanese Prime Minister Fumio Kishida saying he'll work to restore confidence in politics. That's as Japanese media are reporting that he plans to replace 15 officials amid allegations over political funding. For more, let's bring in our East Asia government editor, John Herskovitz. And John, what do we know about Kishida's plans and I guess the urgency of the situation for him to potentially have to act?
Sure. We had a report in the Asahi newspaper over the weekend that he's looking to replace 15 ministers and vice ministers from actually the biggest faction within the LDP, the faction that was headed by former Prime Minister Abe. This would be probably one of the biggest changes for his government. It's just over 2 years old, and it's a bid to restore trust for a scandal that just keeps snowballing. More and more revelations come out day by day. So he's trying to make dramatic changes and timing it to a passage of the budget, which is supposed to come Wednesday.
What does this mean for his administration? I mean, he's been plagued by low public support already throughout.
Exactly. It's going to be difficult to restore public trust, especially with a scandal like this one. It's a drip, drip, drip scandal. And if you don't mind a mixed metaphor, there'll be other shoes that are going to drop in the next few days. So he may try to get out ahead of it, but there'll be details that come out that aren't going to look good for the ruling LDP, for his government. And he's also trying to win support for economic policies. It's a difficult period for the Prime Minister. The public hasn't really warmed to what he's put out there, and he's trying to reverse a slide that has put his poll numbers at some of the lowest in about a decade for a Japanese premier.
Bloomberg's East Asia government editor John Herskovitz there. And here are some other political headlines around the world. Philippine President Ferdinand Marcos Jr. has slammed China's actions against Filipino ships in the South China Sea over the weekend, calling them a blatant violation of international law. The Philippine Sea Task Force says its vessels were damaged after being directly targeted by a Chinese Coast Guard ship with a water cannon, while another Filipino boat was rammed. China's Coast Guard says the boat ignored warnings and deliberately collided with its vessel. Egyptians began voting Sunday in a 3-day-long election, with President Abdel Fattah el-Sisi all but certain to win a third term, even as the North African nation grappled with its worst economic crisis in years. The most pressing issue for Egypt's electorate is the soaring cost of living, with inflation running at almost 35% after 3 currency devaluations since early last year. Javier Milei has been sworn in as Argentina's president. In a message to the nation, he warned Argentines will have to endure additional pain while he works to pull the country from an economic crisis. Milei has pledged spending cuts and said the economy will worsen before turning around. The leader's cabinet pick triggered a rally in the nation's dollar bonds and stocks. Plenty more to come on Daybreak Asia. This is Bloomberg.
Well, China is the dragon that has awakened, but I think it's still half sleepwalking. So hopefully, as we usher the year of the dragon next year, we will see China really, fully awoke to the prospects of air travel recovery.
Association of Asia Pacific Airlines Director General Subhas Menon. Let's get the outlook for the travel and transport industry as we go into the holiday season. Parash Jain, Global Equity Sector Head for Shipping and Ports and Head of Transport Research for APAC at HSBC, joins us now. Parash, great to have you with us. We just heard from Subhas Menon, and what was really interesting from his comments was that we are seeing a recovery in Asia travel, but it has really underperformed the global rebound, and a lot to do with China. So what can we expect from that market into year end and into 2024?
Yeah, absolutely. Thank you. And as Subhas mentioned, right, barring China, the rest of the world's travel has already reached pre-COVID level. Even China domestic has achieved pre-COVID level several times in the past year and two. Only missing leg was the international travel. And probably with the effort towards visa-free deals, whether with Malaysia, now with Singapore, probably they are moving in the right direction. Within the China's international travel, probably the travel to US was one of the weakest link this year, and this is where we are seeing some actions happening with China's travel to the US has now reached about 22%, and that probably will single-handedly drive next year's growth for China and as a result for Asia.
And with more China-US flights now scheduled, given the thawing of that relationship, how much of a boon will that be?
So as I said, right, if you look at China's international capacity, today they are hovering at about 53%. If you talk to the big three Chinese airlines, they were aiming to get to 60 to 80% by the end of this year and perhaps reaching full capacity sometime in next year. But we are slightly more cautious. We are modeling that probably it will be early 2025 when China's international travel will reach back to the pre-COVID level. But needless to say that from current 53, even if they reach to 80, 90% next year, you are seeing international travel doubling on an average in 24 versus 23.
Will what happens towards year end sort of reflect what we can expect from February 2024 around China's New Year holidays?
So you're already seeing, if you see the commentary from the trip.com or Tongcheng Ilong, we have already seen a lot of search activities built up going into the Chinese New Year and also to the mid-autumn. And especially with the visa-free access or the 30-day free visa access to Malaysia and Singapore, those are the two markets probably you will see travel surpassing the pre-COVID level. Singapore has already achieved close to 80% as we speak. So probably those two markets will see the growth along with Thailand and Japan of the world.
Tell us then a little bit more about whether Thailand, Japan, and what other markets will be the bright spots for 2024.
And if you talk about the growth, I would still say it will be US because it was pretty much was not moving at all in 2023. However, in terms of the volume, it will be Southeast Asia. It will be Malaysia, Singapore, but probably in terms of the sheer volume, we'll still say it will be Thailand, Japan, and Korea, those three markets.
What about the shipping market? Is it a whole different picture when we're talking about containers and actual trade volumes?
Yes, so I mean, shipping, you have to see container, bulk, tanker. There are some Christmas cheers in some of the markets we have seen recently with the dry bulk. But yeah, when it comes to the container, probably we have seen the freight rate bottomed out somewhere around September. But given the excess capacity that is impending for 2024 and 2025, our base view is that the freight rate will bounce around the bottom, and probably it will be increasingly difficult for the shipping industry as a whole to remain profitable going into 2024. And if you look at the volume data, probably you have seen that the global trade has started to perk up. Some of the talks about excess inventory has cooled down. So I don't think that demand is much of an issue. But on a base such as this, demand is unlikely to move the needle. If you're bullish, probably you'll look at 2-3% of demand growth. If you're bearish, you'll be probably looking at around flattish. But this is up against about 8-10% of the supply growth, and which is pretty much dampened the outlook for the container shipping going into next year.
How much more pain will the shipping industry just face because of the tougher emissions regulations that we could see in 2024 and onwards?
I mean, if you talk about from the shipping lines perspective, I would say that the demand and supply mismatch is a far bigger challenge for them. I mean, we did some calculation on how much the EU ETS, the upcoming regulation in Europe from the 1st of January would cost them. I mean, on their overall book, probably the impact will be less than 1.5%. And this cost, they have seen it in the past. It's easy to pass through it to the customers. But at the end of the day, it boils down to the overall freight rate, which is where we'll continue to see the pressure.
How much progress are we seeing in these companies really changing to those alternative fuel ships and that transition into more greening of their business?
Well, I mean, so first of all, as we know, right, they are the consumer of that fuel, but they need the support from the oil majors, they need the support from the regulators. But for whatever they have in their control, if you look at this year's order book, I think close to 55% of the vessels that has been ordered have alternate fuel capabilities. So with respect to the new ordering, I think they are walking the talk. And then you have some of the leading players who are gone a step ahead in terms of securing the alternate fuel, such as methanol in case of Maersk. But I think it's just a too big a task. And today's alternate fuel availability is low single digit.
Parash, what are your calculations and assumptions when it comes to the global economy next year as you look into these freight rates and container volumes, especially when it comes to also air cargo as well as compared to 2023?
Well, okay, so that's where probably there are some Christmas cheer. Maybe let me talk air cargo first, right? So we have already seen the air cargo freight rate, particularly from this part of the world, Hong Kong and Southeast China. We have seen that the rates have, out of these regions, are pretty much double of that of 2019. That's primarily dealt with the fast fashion, some of the cross-border e-commerce supplied by Temu and Shein has fueled this market. And probably players like Cathay Pacific in this region, some of the global integrators are set to benefit from this trend. I mean, recently IATA has come out with their forecast for air cargo next year, and they're also looking at about 4.5% of annual growth in terms of the volume. So probably there are some cheer on the air cargo, but bear it in mind that at this point of time, it was the lack of belly space capacity out of China coincided with a turbocharged e-commerce cross-border growth has fueled the market. 2024, with the belly capacity coming back, probably you will see some of this euphoria will calm down, but the outlook certainly looks much better compared to the container shipping sector.
Parash Jain there, thank you so much for your time today with an outlook and a view of the transport industry going into 2024. HSBC Global Equity Sector Head for Shipping and Ports and Head of Transport Research for APAC. And of course, if you missed any part of that conversation, TV Go is your function. You can also watch us live. You can dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
Well, Jack Ma, of course, made headlines for comments that he made in an internal company forum where he congratulated Alibaba's little-known rival PDD Holdings. Pinduoduo has been winning over customers in the domestic e-commerce market with a range of innovations, busting onto the US market with that shopping app called Temu. Today's Big Take has a close look at the company that's posing a challenge to the likes of Amazon or Walmart. Let's bring our China Tech reporter Sarah Zhang, who joins us in Hong Kong. So, Sarah, we've been talking a lot about these, fast and furious or cheap and cheerful, I guess you can call them, apps like Temu, and of course some of the other Chinese-owned or Chinese-linked businesses like Shein as well. They're really making headway in the US market.
Yeah, no, that's right. Especially Temu. I mean, they just came in late last year, and they've already soared to the top of app stores. And they've expanded very rapidly, already into over 40 different markets globally. So it's really increasingly a force to be reckoned with. We saw just a few months ago this summer in May, they already overtook Shein in terms of overall transactions, and then that gap between them is only widening. So definitely an app to be reckoned with, and it's making PDD something that investors are increasingly very interested in.
Why? Why is it so popular?
So what we've seen is that PDD has just built its success in China domestically over the years with quite innovative e-commerce models. One is this gamification idea of e-commerce, where they try to make shopping fun. They include games and other rewards to try to stimulate people to come back and to use the app and create that sort of like social community kind of experience. And they're bringing that model to the US. So that's one thing. And then they have this consumer model where they directly source products from the factories themselves, and that allows them to really keep the costs as low as possible.
It wasn't always easy, though, right? I mean, PDD suffered plenty of setbacks after going public on the Nasdaq in 2018.
Definitely. I think one of the big problems that they faced, especially early on, is the proliferation of fake goods on their platform. So that's really something that they tried to tackle, especially in the early years under their founder, Colin Huang. That was something that he made a priority. And now going forward, the big question that people are asking is how sustainable are these low prices and big subsidies that they're introducing for their products?
There's also going to be political challenges for a lot of these China-made, China-linked, China-owned companies.
Definitely. I mean, I think there are fears that Temu could face the same kind of treatment that TikTok has in the U.S. There has already been a little bit of congressional scrutiny, but we know from analysts that e-commerce is generally not as sensitive a space as social media. So it'll remain to be seen how much scrutiny that actually does attract on Capitol Hill.
China tech reporter Sarah Zhang there joining us from Hong Kong. And take a look at how markets are trading early in the Asia session right now. We are seeing really broadly green, especially on the Nikkei, where every sector is gaining ground at the moment, being led by tech and healthcare and industrials as well. This, of course, following some losses last week where we had seen one of the worst weeks for the Nikkei 225 so far in 2023, given this surge in the yen that we saw in the past few days. Not so much today, though, where we're seeing some downside pressure against the U.S. dollar. Take a look at the Kospi holding steady at around that 1 week high. We saw the stock market really gain ground last week, with the Korean won also jumping the most in more than 3 weeks against the U.S. dollar. We're seeing their trade numbers also improving slightly in the 10 days of December already. Exports rising 3.3% year on year. Of course, we have seen that acceleration in those trade numbers for the month of November already, given that rebound in semiconductor demand. And the ASX 200 also pointing to the upside of 0.3%, as we're seeing the Aussie dollar holding steady after weekly loss against the U.S. dollar. Perhaps a lot to do also with what we're seeing in the commodity space, with iron ore rising to a 10-month high. But really, it's a lot to do when it comes to currencies, to the strength of the U.S. dollar against these Asian currencies after they jumped on the payrolls data that we saw last week as we head, Heidi, towards the FOMC rate decision. Not a lot of change expected this week, but of course, we're setting up for what happens next year, and swap traders now expecting perhaps less easing because of a resilient labor market.
Yeah, and it's interesting you say not a lot expected, but perhaps a lot expected when it comes to central bankers, including Chair Powell, how they engage and how they communicate, right, the messaging. Why are they not in a hurry to potentially flag easing when we have seen the data points suggesting that they could? And it's the same when it comes to the BOE and as well as the ECB, right? The Bank of England set to announce its next policy decision this week as well. Policymakers and markets, they're still at odds over the outlook when it comes to rates, and that comes just about 2 years since since the hiking cycle began. We're also looking at some of these skewed ECB rate cut bets as well. These looking a little bit risky, potentially regardless of what we hear from Christine Lagarde. The risks for European bonds, according to analysts, looking asymmetric after what we've seen as a pretty strong rally. A hawkish ECB could lead the markets to really pare back bets on a March cut and some repricing and volatility there. That is it for Daybreak Asia. Our markets coverage continues.